Welcome to Breaking Banks, the #1 global fintech radio show and podcast. I'm Brett King.
And I'm Jason Henricks. Every week since 2013, we explore the personalities, startups, innovators, and industry players driving disruption in financial services.
From incumbents to unicorns, and from cutting-edge technology to the people using it to help create a more innovative, inclusive, and healthy financial future. I'm JP Nichols, and this is Breaking Banks. As the costs of meeting customer expectations and competitive pressures continue to rise, more banks are considering mergers and acquisitions to gain scale and stay relevant. But there are deep structural regulatory constraints that can often be an impediment. Everything from the way geographic boundaries are defined, to the way competition is measured, to the way that products and services are measured and defined, have origins that don't seem well suited for today's financial services landscape. As we lead up to Bank Directors Acquire or Be Acquired conference, Kiah Haslett, managing editor for Bank Director, is here with us. So if you've listened to Kiah on the show before, you know she's a self-professed regulatory nerd. She's also a soccer referee, so I want to talk about the parallels, if we have time at the end here, of being a regulatory body on the field, and we haven't talked since the World Cup. But Kiah's going to walk through some of the increasingly outdated modes of analysis and some of the ways that regulators are planning updates. And we're going to debate whether it's all enough to achieve the stated goals of maintaining competitive markets for the good of the public. So, Kiah, welcome back to the show. And you noted, you quoted actually, noted Bank M&A attorney Peter Weinstock in your article. It says, part of the problem is that regulators tend to have a 1950s view of the banking system. What does he mean by that?
Well, thank you, JP and Jason, for having me back. I'm really excited to talk about this with you because I think this, the reason was why banks do M&A, and then the framework by which M&A deals are assessed by regulators. There's some real tension there that I think a lot of regulators want to change, but we don't know what direction they're going to go. So I was reporting on this for my Q1 23 issue for Bank Director magazine, the competitive concerns for a deal. And I learned in this that that regulators have to assess for the competitive impacts of a deal from a 1960 Supreme Court decision. And they needed to figure out what happens to a market, options, services for customers and businesses after a deal is approved and closed. And then the framework, the HHI index, actually comes from two 1950s economists. The framework was invented in the 1950s.
Well, can you pause there and talk about what is HHI? What does that mean?
It's an index that, basically, the way I understand it, and this might be wrong because I kind of only understood on the outside, but it calculates a geographic market, and then it looks at the businesses and banks that are in each market, and tries to quantify their impact on the market. And so when two banks want to combine together, regulators look at how those banks the combination of those two banks and their individual HHI scores will impact a market. So that's what banks talk about when they talk about passing the HHI test. And it's something that you can quantify. I just don't have it's available on S&P, or the Federal Reserve can do this. Any bank can calculate their HHI score. And so if you're a bank A and you want to buy bank B and you're in town C, you can calculate what the HHI score will be in that market. And so this is a big thing that comes up ahead of deals being announced. Banks probably it comes into who you would even try to combine with because of the potential HHI score.
Yeah, the Herfindahl-Hirschman Index, HHI.
I wasn't going to pronounce it. I'm sorry.
I wasn't going to pronounce it either. I was avoiding that. I was hoping Kiah was going to pick it up.
Thanks, JP, for taking that one.
Well, everybody just calls it HHI. But, Jason, it seems to me to be a pretty blunt, not to mention outdated instrument.
Well, it worked when the nature of competition was branch-based and your ability to lend, right? Let's break down what is the fundamental business model that has not changed since the days of Medici. Taking deposits on one end, lend them out at a higher rate, on the other end. And predominantly the way community banks have been able to compete effectively is they're good at gathering deposits from both consumers and small businesses that have relatively stable and larger amounts of deposits. The bigger you get, suddenly you get very sophisticated because those deposits represent working capital. And so you begin to farm it out and do a lot more sophisticated things when you get up to the commercial side of the house, right? And so where are they able to compete on the lending side is really around doing small business lending, right? It is, can be just as expensive to lend to a consumer as it is to a business. So you're a lot more comfortable saying, hey, it's worth putting the time and energy in to make that bigger loan, right? So if you think about it, why is it a blunt instrument that worked historically? Is your branch footprint equated to what your deposits were going to look like, and it was bound by geography. And you can extrapolate because your ability to gather deposits are very quickly going to determine downstream how much lending can I do.
Yeah, I was surprised to learn that. So for regulators, they look at the summary of deposits, which is branch based. That's an annual survey. And they actually just use deposits as a proxy for loans. And there's some real tension there because I think, you guys could certainly talk about how deposits are gathered today, especially, for businesses, and then where loans are made.
Yeah. Well, in my first time I hit the HHI was when I was at First Marblehead, the large private student loan company in the early 2000s. And one of my jobs was to launch a high yield money market. We were actually doing about $1 billion of loans on the house loan, right? So it was like Chase, B of A, and then our Strive loan, right? So this CFO realized, like, wait a second, if we actually were a bank instead of using a warehouse line, that would be save us several hundred basis points. And so it's like, hey, Jason, we need to go be an online bank, right? And at the time, think 2008, we're 1 year into the iPhone at this point. There really was Kiah Haslett, right now just known as Kiah, Wingspan. And, what we set out to build is a high yield money market. And as you began to look at the HHI index, and they were asking to define the competition, really there are two parts of this. One is, they were looking at the geographic footprint, except we had purchased a small thrift in North Providence, Rhode Island for the charter for this thing, right? Except our deposits were coming from everywhere. Why? Because, when you're paying getting 16 to 18% on your loans, you can pay a lot more interest than anyone else in the market. And the regulators, just their eyes went wide. They had no concept for, you only have two branches. How do you have so many deposits?
Have to be attributed to your location in Rhode Island. So you just had this like giant branch in Rhode Island.
Yeah, that's what it looked like.
SOD.
By the way, I'm 90% sure that branch had black mold in the basement, just to tell you the caliber of the institution we relieved the OTS of.
Well, that's a real problem for banks, right? Like this is just the system we have, and it's the data that gets put into the analysis, and that increasingly that analysis is missing some really, really important competition.
Yeah, in the second thing they assess, though, so first is around deposit concentration, because it's easy to quantitate, and that means, hey, if I have a number, I like to be able to compare numbers because it feels fair. Although we have a few exceptions, more recently where the Federal Reserve Bank has, done analysis and realized the numbers, in fact, were lying. But the other is the overlap of products and services. And this is where things get really tricky, because when you look at overlap of products and services, is a debit card or savings product issued by a fintech that has a issuing bank sitting behind it, is that the same product as a debit card that I can walk into a branch and get, right?
Well, and then the measure of if all of that's attributed to your single branch location in Rhode Island, how does that impact other, financial institutions in that defined market area?
Like what's being missed if some bank in Rhode Island wants to buy another bank, and then that competition is totally misweighted.
Right. So How are those geographies even defined? Who's responsible for that? What does a geography look like? Is there consistency across that? I think I know the answer to that one.
Well, I learned from a speech that Governor Michelle Bowman, Fed Governor Michelle Bowman gave in September 2022, that the Fed is responsible for creating these banking markets. And there's about 1,500 of them. They have to be constantly updated. And it's not always clear where they define the boundaries of a market. So in my story, Peter Weinstock and Pat Hickman, a retired banker, told me about Plainview, Texas, which is halfway down a 100-mile stretch of interstate. And
having driven through it, I'm just going to define it is halfway to the middle of nowhere, if not 3/4 of the way to the middle of nowhere.
And they were talking about how there are people that do live in Plainview. But when people want to do commercial activity in Plainview, they tend to drive north or south to two different other cities. And that Plainview as a market, as people live in that market, maybe do not understand it to be a distinct economic area from, Lubbock and Amarillo. And that they went through a lot of arguments with different regulatory bodies, including the DOJ and the Federal Reserve, to try to help these agencies understand how commerce is done in this market, because Pat's bank, Happy State Bank, wanted to purchase another bank that was in market that would have led to a concentration. And so they were, they tried to say that this is a very rural, and, this happens in rural markets, that they concentrate a lot faster, they have fewer institutions. And also that rural markets, these banks do probably need scale to grow faster than maybe a bank in a more urban market.
Well, and let's talk about scale, because this is one of the things they talk about. It's like, oh, wait a second, if we reduce the number of banks, we're going to have less competition, because we needed those 2 branches in town. So you had a choice of whether you're going right down Main Street or left down Main Street for your banking, all your banking needs. But the real problem is, and I think you did a great job in your article in highlighting this, when you're subscale, your ability to actually provide the products and services that your customers need for, to meet the changing expectations goes down. And I love one of your example there, that, they needed to upgrade their mobile app. That was going to cost $1 million. And, they didn't have $1 million sitting in the bank, given, their size. Mm-hmm. And I would say mobile app is just the tip of the iceberg. That there's a whole host of other things, that the mobile app is actually just a defensive mechanism.
Yeah.
Well, you add to that this situation where banks are beginning to look outside of gathering deposits and making loans, right? Driving more fee income. And so then these blunt instruments become even more blunt, because they really aren't representative that when we say deposits or proxy, it ends up being probably not a horrible proxy for loans, because that ends up being the limiter on the loan volume. But what about the other kinds of services that are being provided?
Yeah, it's not clear to me that it feels like deposits and loans are what's prioritized in the analysis. To the DOJ, you can argue that if a in-market deal is approved, it would actually expand products and services, and I find that to be very compelling. That comes up a lot in deal rationale and deal calls. A bank will say, we're buying this bank in town, but we can expand the lending limit, or we can give them more insurance services or treasury management services that the smaller bank didn't have. And that makes sense to me, that the smaller bank might decide to be acquired by an in-market competitor that they're really familiar with, and then see that as an expansion. The other thing too, and with loans, in my story, Peter Weinstock and Pat Hickman argue that in Plainview, Texas, that the municipal deposits were kept at an out-of-state competitor. They weren't at a local bank. And they also argue that there were up to 30 or 40 non-bank lenders in the market. And I found that to be compelling, because I think, we think about consumer lenders, like non-bank lenders. But I was thinking about, they were talking about Farm Credit Bureau, and I'm sure there are a lot of other types of agencies that will make loans that these banks are encountering when they go to compete for the credit, and realize like, they're losing out on this business. Do you guys want to talk about that at all? The product, services, and loans from non-banks?
Product, services, and loans, but I want to hit part of the M&A piece of this, right? And Kiah, normally I love having you on when we're going to be having hot sauce, and especially when it's you, Alex Johnson, and I doing hot wings and hot takes. By the way, shipping later today is your Provoke branded the spiciest takes in fintechs custom hot sauce. But here's my hot take on this. I want to believe that if it was easier for community banks to merge, that the smaller institutions are going to survive. Except, and I've written about this, that regulation is actually just one of the speed bumps towards this. It really comes down to these smaller institutions. And I used to work in M&A back in the day when I was a strategy consultant. These synergies are really hard to come by, and it's getting worse because these smaller institutions have massive technical debt. I no longer need your branch footprint. So this idea I'm going to save money because I can close one of the two branches in town and just give the same level of service with, half the cost. I got to do something with the real estate, right? And it's not like I used to be able to solve it. Third is, if I'm just buying something that are my existing products and services, which I want to, come back to, right? Like, does that actually benefit me? Because I still actually have to, port you onto my system. And then it's, I've probably lost a lot of people along the way. I've never done a core conversion where at the end of it, it's like, wow, I magically gained 10% of customers. No, I probably lost 10% of customers somewhere along the way, or the activity. And the last is, I don't want your people, because your people are the ones that produce this exact same thing in products and services. If I'm acquiring something, I need to be more like a tech company that's doing an acqui-hire that is actually bringing me new talent that can do new things, right? And so that leads me into where you were going, Kiah, is the new products and services and the overlap of product set, right? Acquiring another small institution that looks and acts just like me worked in a world that you could try and rationalize expenses, but I fundamentally don't believe that to be true.
Well, both things can be true, right? You might be able to spread expenses out on a bigger base, but that doesn't give you any strategic lift, right? And
but I would argue, though, that the cost of reducing those expenses is probably not. This is what I learned in M&A. It always takes longer and is more expensive than you expected.
Right. And we've also talked about, the two ways to get operating leverage. You can cut expenses or grow revenue, and the growing revenue part doesn't necessarily get any easier because you've acquired another bank just like you, and now you're double the size. But you bring up another angle I want to explore a little bit. And so where we started was the tension between your regulatory approach and what banks want and or need, but even within the banks, then we have buyers and we have sellers. So let's talk a little bit about what are buyers looking for, what causes somebody to want to buy a bank. We just talked about one thing there. Why are people wanting to sell, and what are some of the tensions that come between buyers and sellers, and particularly now compared to, say, 10 years ago?
Yeah, I mean, well, I think, if I could talk broadly and historically, or I could talk about 2021 M&A. Because 2021 M&A was down almost 40%. Or sorry, 2022, the year has changed. We are in a new year. 2022 M&A was down 40% compared to 2021. And it was the pace of deals in 2022 is about half of the pace of deals in 2019. That is from a Piper Sandler report looking at 2023. So 2022 was a very weird year for M&A. I think broadly, buyers want to buy good banks for sell. And there's a real tension because the good banks don't necessarily want to sell, or they need to sell for a really compelling and specific reason. And so there is a tension between who wants to be bought and sold, who wants a buyer, and then who wants to buy that bank. And I think Jason talked a lot about the relative attractiveness of some of of some of the banks, right? That a lot of banks are dealing with legacy footprints, legacy technology, legacy people, and that while that might be fine from a growth perspective, given this bank's potentially long history and existing cost base, it's maybe not going to be attractive at the premium or price a seller or a buyer wants to pay. And I think buyers are getting really specific about what they want from deals. To Jason's point, there's just a lot of cost in M&A, and analysts and investors don't like projected revenue or synergies. They completely discount that from from the purchase price, from the premium that's paid for the deal. And so in M&A, it's really, really about cutting costs and controlling the things that you can control and hoping that you get some unexpected revenue synergies, and you get all of this within a reasonable time frame, hopefully within 5 years. I think right now buyers want deposits and they want growth, but sometimes I would guess things like what core do you use comes up probably more than it should in a conversation with potential sellers. I think it's hard because it's like, what are you actually buying? Are you buying good customers? Are you buying good loans? Are you buying good technology? Are you buying data? Right now in 2023, we both have the issue with the unrealized losses in the bond book that a buyer and seller are going to have to price in. And then we also have all banks are under CECL, which means that there's going to be the CECL double count that happens when you record a deal. And these are accounting metrics or things, they just shouldn't drive a deal, but they come in the price, and people really have emotional reactions to the price. So I think M&A is
nailed
murkier.
it,
I think it's
though,
harder.
right? There's this disconnect, right? At what buyers think they should be paying, given all of these impediments that historically have not been so significant, and sellers, still look back and go, "Oh no! Look at how good of a bank I am. I'm a well-run bank," and even a well-run bank isn't necessarily attractive. And I'd say a huge portion of this, building off your comment, they want deposits and they want growth. They just don't want deposits. They want deposits that you're not paying a lot for that muffler, right? So non-rate based deposits. And really is, Ron Shevlin's written in his Snark Tank about the, deposits are becoming the Roach Motel, where your deposits check in and they check out just as fast, and they're being sprinkled across lots of other places. If you're going to actually compete and become attractive, you need something that's differentiated. Being a well-run bank is not actually making you an attractive target. Having some lever that you have deposits that you can scale and you're not competing on rate, that makes you attractive. Having a new set of products that others, don't, and, that's going to open up new opportunities. Again, a merger of same isn't going to work.
Whose expectations are most unrealistic right now, buyers or sellers?
Oh, that's so hard because we have so little data to go on. I think so. Sellers always, in Bank Director, and you should have told me you're going to ask this question because I could have looked up the answer, but we actually do ask sellers kind of what they would want to receive for their bank. And I, if I had to guess, if it's over 120% price to tangible book, most buyers can't pay that because of where bank valuations are. And so I think, I think sellers probably always want to get a premium. They probably think that, again, I think it's really good that there's a lot of well-run banks. I think that's great, but I also can see that that's maybe not as compelling of an offering when a bank is for sale. And so that's it. I do agree with Jason. There's got to be something else. And so kind of communicating that with sellers, I think a buyer knows what they want, and a buyer is probably looking for something they can't do themselves in the time that, in a certain time frame. So I guess I would, nothing against buyers and sellers. I love M&A. I came up doing deal math and being a real nerd about that as well. But I do always think sellers are probably the ones that have the biggest conversation about what's realistic and what they can get.
Well, in compounding that, right? So Key and I will agree on this one, so not so spicy, but compounding the problem is, given the number of banks that we have, that, like, say there's a large number of well-run banks, but they're a diminishing asset because their customers are aging. There's more competition entering the market. I don't know anyone who's banker that I talk to right now that goes, "Yo, we're crushing our deposit growth," right? Without, competing on rate, right? So diminishing asset that is compounded with the number of bankers that look at this and they go, I don't know who the next generation is that's going to lead this bank, especially family-owned banks. So I'm going to go sell. So when you look at the amount of inventory of well-run to pretty well-run banks in the market that all think they're worth a premium, and the buyers are like, well, one, we have a disconnect on price, but two, I'm just going to keep shopping because there's plenty of banks and more coming, onto the market.
Yeah, I still hear a lot of bankers that have the 15-year ago high water mark. It's still in their head, right?
Yeah.
That they think, well, those days that's normal, and so there'll be a return to normal. Oh,
it has been really interesting to see the change in valuation. The other thing, and we hadn't talked about this because it's so specific, but there were like a handful of mergers of equals, and that really changes the valuation averages of banks. If you have a no premium deal, and then it kind of weights down all the 150% premium deals. But and that's specific. And we don't necessarily need to get into that. But that sounds like it might be probably an option that more banks should consider, especially more on the smaller side, under $1 billion, because you can just gain scale so rapidly, and then maybe you can get enough scale that you become attractive to a bigger buyer.
But those same challenges still apply, right?
Completely.
Just gaining scale doesn't get you there. So Jason, I want to ask you this: if and Kiah, you can weigh in as well. But if you're a non or an asymmetric competitor, you're a fintech, you're not a normally regulated financial institution. Is all of this mess good news or bad news for you?
Oh, great question. I think a lot of it is bad news, right? Because there's a lot of fintechs that want to go buy banks to have the charter because they've realized, for fintechs, there's two business models. I think I've figured out a better mousetrap when it comes to lending, except we're entering a cycle right now where it turns out, AI and machine learning to create a new alternative underwriting, that's going to be tested. And I'm going to be the naysayer on that and say, no, you just found out, this is an Alex Johnson one, that, lending the money out isn't the hard part, getting paid back is. And the other are the fintechs that are focused on is payment vehicles, right? That are interchange dependent. Well, the cost of running those programs is doing nothing but going up. And so the realization for a lot of these well-funded fintechs is if I just go buy a bank, I actually can fix my business model problem. But now you're getting into, something that's just in complete disarray. So I think that makes it a challenge, right? Because buying a bank is necessary to fix your business model problem for the well-funded startup, because they never had a business model in the first place, but they're unable to do it.
Over the last couple of years, we've seen banks buying fintechs and fintechs buying banks. Do we see more of that or less of that going forward?
Kiah, what's your bet?
I think we've had a change in regulatory interest in approving these deals. I think there's going to be heightened regulatory scrutiny. This probably isn't the conversation, but the backgrounds of the buyers, I think, are probably going to become, especially if you're a non-bank buyer, are going to become really, really important. We do have some investor groups that have been able to buy banks that aren't straight up fintechs, but and do want to use more fintechs to deliver their banking services without necessarily being a fintech or banking as a service bank. But I don't know if I think more charters are for sale versus more deals getting approved. Those are two different questions. Maybe there are more charters for sale. Maybe more banks would consider this, especially if they realize their smallness is an advantage to these buyers. But I don't know if I think regulators are going to be hot on these applications.
Well, and the question becomes valuation then, right? Because for a relatively well-run bank, the fintech that has a lot of money is willing to pay a higher price because that charter is, more valuable, and they have cash, right? Those who don't have a business model but raise too much money in the hype years need to fix something before they run out of cash, right? The boat is sinking. How do I patch it? And bailing, with the tin cup isn't going to do it. Buying a charter is, more extreme. Let's take the boat in to dry dock and try and fix it. But the challenge is going to be when you look at, they have the cash, but they're not actually interested in the existing business. So with my M&A hat on, I look at it and say, like, well, tangible book, I'm a fintech, I don't know what that is. I want to talk about SaaS multiples, even though I really don't have a SaaS business. I'm really a finance business, but I'm trying to sell myself as a SaaS. How do I think about your business and what you're worth?
And how do we think about the international market? Part of that increased regulatory scrutiny includes looking at foreign ownership. We've seen over the last couple of years some of the large foreign banks that bought U.S. based banks have spun those off. Do we see ourselves getting more isolated or more connected to the global finance economy?
Oh, I mean, forget even going global, JP. Throw in the complexity when you have venture capital investors. I was doing diligence in, well, I won't name the year because you can start to work backwards to what deal it is, but it was one of the first neobanks that was becoming on its way to becoming a unicorn. This was the Series A, first real institutional money. And I was explaining to the VC that they were going to need to, share a lot of their ownership details, including some financial information, right, related to this. And they freaked out. And they're like, "We're a fund. We don't do that with any other of our portfolio companies." It's like, welcome to investing in regulated things. It's going to happen.
Yeah, I think it's hard to extrapolate based on the international activity because we've seen really large international players. So TD bought First Horizon. That deal is in limbo. It is, I believe, it is still pending. But we've also seen, I think, is it Union, Mitsubishi, MUFG sell their U.S. arm to U.S. Bank,
right.
And I think, was there a
Bank
BMO
of the West,
deal? Yeah, Bank of the West
sold off by BNP Paribas.
I would wonder if the CCAR requirements and the living will requirements and the international or the need to have an intermediary holding company probably are playing a little bit more for those guys versus like what I think you were asking, which is an international firm buying a smaller bank. I just do think that regulators, especially after that bank in Washington, was it Moonstone Bank, after it was discovered that there were questions around some of the ownership and just even like the review of the ownership itself. It is a lot of work to buy a bank. You can go look up a court case where I got sued for writing articles about someone who was buying a bank and how regulators should approach that. Like just if you've got, in my case, if you have violation, if another regulator has taken action against you, a non-bank regulator has taken action against you, and then you own a trust, and then you try to buy a bank, do you get to buy the bank? So those are, these are like questions that I think regulators are going to be very interested in, is who wants to own these banks for what reason, and are you going to change the business model? And that came up also in my reporting about de novos, that if you plan to change a bank's model a lot, that gets a closer review in the proposal than if you would just like build a bank yourself.
Yeah, I mean, I just bring it up because increasingly the financial world is smaller and smaller, and the biggest advances are coming, in Asia and Africa and South America and emerging markets. And so we talk a lot on the show about, the U.S. versus the rest of the world, even though it's not, quite just a simple dichotomy. But I think my sense of it is we tend to get, at least in the regulated bank space, a little bit more insular with the way that we're going here. But having said that, you cited in your article, Kiah, that acting comptroller of the currency, Michael Hsu, does support kind of looking at new ways of analyzing bank mergers. And he talks about, so bad mergers are prevented, good mergers are allowed. Well, can we start with what is a bad merger and what's a good merger? I think we understand from buyers and sellers standpoint. What do the regulators think is a good or a bad merger?
Well, I've written or I've observed, and I know Alex Johnson has written about this, that Comptroller Sue talks a lot about his experience leading up to the financial crisis. And if you're looking for some bad mergers, maybe go back to like maybe 2004 to about 2007 and look at some of the prices. Look at some of the institutions that were sold. I think Bank of America still might be paying for some of Countrywide's shenanigans. Bear Stearns, JP Morgan, I know, is paying fines on that for a while, although they got a pretty good deal. I think like this is not spicy at all to say like the Countrywide was probably a bad merger on a couple of fronts. The way that they were growing was not going to be good long term. There was too much money. There was a lot of legal liability. And I think that is a bad merger. It's hard though, because I don't know what the role of the regulator should have been to discourage Bank of America from buying Countrywide. I think if I was the FDIC, isn't it better that Bank of America takes on that legal liability rather than FDIC having to find a buyer, needing to do a loss share when Countrywide fails? So I do think there is actually like a pretty big open question of what is a good merger, what is a bad merger, what does smart mergers look like? I don't think we've seen a lot of quote unquote bad mergers. We've seen maybe some bad integrations, but I think most banks, I think, are very cautious about buying the legal liability of their sellers. And they, they don't want a deal that becomes like a thorn in their side. Do you guys have any thoughts on bad mergers? Have you seen any bad mergers recently?
Well, I mean, again, historical bad mergers, right? Like it's easy to find the roadmap and say, oh yeah, we shouldn't have done that. To your earlier point, we didn't price in bond losses, or we didn't think about loan loss reserves because of they've been growing and their book looks great. We didn't bake in that we're facing a possible recession, or at least a slowdown in the economy. What does that look like? Or concentration risks. Those are the easier ones. I think the hard thing in finding out what is a good merger as opposed to the bad merger is the landscape's changed, right? Like historically, what was a good merger was two well-run banks coming together, increasing their footprint, not too much branch overlap. So we're not, closing a ton of branches, not too much concentration. Those were historically good things. And I don't think that's the right yardstick anymore.
I will also say we've seen, from a good, bad merger regulatory perspective, we have seen at least one deal where regulators extracted a concession around branching, I believe, a low to moderate income community. I wonder if one of the concerns from a regulatory perspective that is a little bit more outdated is that when banks integrate and close branches, that they create banking deserts and people lose access to products and services. Now, to Jason's point, the way that products and services are getting delivered is changing. So it's not necessarily a one-for-one to say that when a branch closes, a community loses access to banking, but it certainly does maybe matter from kind of an investment perspective of just where a bank is willing to spend money to be in the presence of. And we've seen, but I wonder too if the merger framework needs to be a little bit more mindful about where do you plan to close branches? How does that impact maybe a CRA rating? How are you planning on staying present in that community? Does your, would your maybe the ethnicity or the income level of your customer demographic change relative to where you have branches? And maybe that should be included in the framework. But again, that still doesn't capture that non-bank competition that banks respond to in trying to grow and compete.
Yeah. Well, hot take here. If the government is so worried about these banking deserts that are being created, one of two choices: invest in digital infrastructure for the people who are there, and let's talk about physical money needs to go away and let's make it digital, and the government needs to work on that. And I think part of being digital is we need to fix identity nationally. Like physically having to go in and present documentation to someone is stupid. If the government wants to avoid the deserts, go get people more digital. If you don't want to do that, go build a nationalized version of the low-end banking account. Turn the post office.
Yeah, I was going to say, it's just now a conversation about postal banking.
Do one of the other things. You've got physical assets. Go bring a new service to them if it's important to you, or get off your butt and make it so everyone can be digital. Because right now, we're seeing a big divide between a lot of these lower income and rural areas where they don't have access to high speed internet and to low cost services that allow them to be digital.
Well, and the other thing is look at the concentration that we've had over the past several years, and the systemic risk, the too big to fail. We have less than 5,000 banks today. Over 13,000 when I started in the industry, but balances are higher than ever, right? They're concentrated in a smaller number of institutions.
I know this is an audio medium, but I actually, in the same issue, wrote about how there are fewer banks, but there are more banks over 50 billion. And it is actually really interesting to think about, I think as a reporter, the hollowing out of the bank space. So when the $10 billion, when Dodd-Frank got passed, and it created this $10 billion asset threshold that necessitated scale to go over 10 billion, you saw a hollowing out of buyers in the $5 to $8 billion because they got really big really fast. And then we have not seen as many banks come from the 1 to 3 into the 5 to 8. We just don't have those buyers. And so, if we ever do this like retrospective on Dodd-Frank, I would be actually really interested to see how it changed the the $10 billion and under space, and how institutions moved through those asset ranges, because it really did impact, going back to the whole point of this conversation, it impacted who the buyers were for the $1 billion and under.
Back to the difficulty of M&A, right? Like, I would love to see that analysis. I'm hoping you pick it up, Kiah, or, we'll have to.
Not too many people are asking me to write about, 10 years after Dodd-Frank, what the landscape looks like. But I'm really interested. I think it's one of the most unintended consequences of Dodd-Frank. There's been a lot of them, but that was one of them.
I completely agree. And let's think back to what we talked about in terms of the pressure on, why the end of the M&A superhighway, right, is, there's the 4 impediments we talked about. There's the price discrepancy between what buyers and sellers want. So what's the bank of the future going to look like if you look across those asset classes? And I think what we're going to end up with is, you've got a few that are in the league of their own, right? So call it the JP Morgans, B of A's, that are large, international, right? Like they happen to do a lot of, retail and, business banking in the US. And a lot
multi-trillion asset.
Mm-hmm.
Yeah, the multi-trillion asset, right? Like, let's put those aside. But now we're talking about, let's get down to like the super regional, just, good sized bank, 20 billion. And then you've got some on the small side. I would actually hate to be kind of in the middle right now, because I don't think you have enough resources to compete with what I think we're going to see is this will partially be the B of A's and the Wells of the world, in addition to their international businesses. But you're going to have, call it the Capital Ones and others that, like, they are now your Costco, Sam's Club, Target, right? Like, they're big enough that they have scale,
Mm-hmm.
that they can choose how to compete with their massive resources.
Yeah.
Flip to the bottom side. I think they need to figure out, how do I differentiate, right? And I can do that one or two ways. I either need to concentrate on a set of customers and solve a problem no one else is, or I get big into banking as a service and embedded fintech and embedded finance, right? Like, I just give up that I'm not going to be the customer facing brand, but I'm going to take my access to the rails and to, my regulatory prowess. And I'm just going to be a provider of pipes to others. I don't know. What do you think of that, Kiah?
I mean, I think that I think you've actively or accurately characterized like the nature of competition. And if I'm a bank working in an individual marketplace, I probably need to spend a lot more time figuring out who am I competing against and how are they competing against me. And being like, how am I going to respond? And what are the avenues of growth that are available to me? And and at what point do I need to sell? And if I sell, how will I be attractive to that? But I do think like technology has really, really changed banking and has really changed competition, and it's coming up in M&A. But it's also coming up in like, this banking as a service, right? Like when we talk about, these smaller banks, the banking as a service banks may never want to do a deal again, and they will grow through a different way, in part because they have, an effective asset cap. And so I do think that for smaller community banks, their calculus is getting a lot more complicated.
Well, this might be a stretch, but it gives me an excuse to talk to you about soccer again. And we haven't talked since the World Cup, but you are a referee in soccer. What are the parallels that you see being a regulator on the field? And maybe even what kind of advice or direction do you think we need to give to the players on each side?
Yeah. So I just want to, maybe I should always start out my podcast by saying this, but I just want to have a disclaimer that what I'm about to say is just my personal experience and does not represent any of the assigners or leagues that everywhere. I work in.
Or
and
FIFA.
I'm an independent contractor. So if you want to talk about what it's like to be an independent contractor with payments and managing your personal finances, that is a different conversation, but I have thoughts. So as far as being a regulator, I don't know very much. Like I know basically like what everyone I feel like on the outside knows about regulation, but I think about myself as an examiner almost on field, and that I have to, I do not make the rules. I was not consulted about my opinions on the rules in many cases, but I'm responsible for knowing the rules and enforcing the rules, and sometimes having to communicate, to players and coaches. I know that that's the rule in your heart, but that's not actually the law of the game. And so, and that some of the parallels that I see are, kind of that management. I also see some parallels with reporting, but this idea that like I create an environment on a field where there's a little bit of antagonism, but there also has to be some cooperation, right? Everyone's trying to get through this game. Everyone wants to have a good game. Everyone wants to feel that the game was fair. That when I enforce rules against a player, or when I call a violation or a foul or whatever misconduct, that I would do it to anyone else on the field. And so I spend a lot of time actually trying to build credibility on the field before, after, during, and after the game. And that comes off in like my work rate. It comes off in how I address players. It comes out often how I communicate and adjudicate calls, right? Because like I'm just running around on the field and pointing at stuff and being like, that was illegal, that was fine. Like you can only do that in this situation, but you couldn't do it in a different situation. And then having a lot of teamwork and building a lot of trust with, people that maybe I know well, maybe I don't know well, but kind of trying to create a consistent experience for everyone. So, but I also like, JP, we've talked about soccer, I feel like people want, the other thing I want to, kind of promote, if I have the time, is that if you looked at the World Cup referees and were like, I could do that and I could do it better, well, sign up for a class, get certified. If you're in Tennessee, I might even train you to call. And if you are at a game, if you're at any game, don't yell at the referees. It's not cool, especially if they look like they're under 18. Don't yell at them. We're losing referees really quickly, and they can never get better, and we can't serve the game if they're getting abused by spectators.
Well, and just like regulators, it always looks easier from the sideline.
Oh, yeah. And you would do it differently, or like, there's always a mitigating thing. And it's just like, man, I got to make this call and I got to move on with the rest of the game.
Well, although I do hereby declare that matters requiring attention are now called yellow cards by the regulators, and cease and desist is a red card.
Yeah. Prompt corrective action. Those are ejections, or like there's suspensions after the game.
Well, I think you make a really important point. If we apply this to regulators, is historically, in order to ensure uniformity in the application of regulation and guidance, is really all about centralized command and control, right? Like this brings us right back to where we started at the top of the hour on, hey, we've got these consistent set of, ways of measuring like HHI, et cetera, but it doesn't tell the real story. What we actually need to do is push out a better application and judgment at the edge to understand the nuance, because the world is evolving faster than regulation. And historically, the slow evolution meant regulation could catch up. Ron had tweeted about this earlier in the week that, innovation always outpaces regulation, kind of by definition.
Yeah.
We have to embrace that, right? Rather than saying, well, the problem is, innovation, is moving too fast, therefore don't need regulation. No, we need regulation. We just need faster moving regulation.
I don't know, man. There's been some changes in offside, and they came up in the World Cup. And I don't know if everyone appreciated those changes, to make a parallel, how VAR was used in the World Cup. Like, maybe sometimes people were not happy with these blade of grass, the preciseness of some of the decisions. They just didn't feel correct to the viewers, even though they were definitively correct on the VAR. Yep. So it is funny because also rulemaking just takes a really long time. It's really deliberative. And then, man, you do not want to be the referee on the first game of the season after a rule change has gone into effect, because you have to explain to everyone who maybe didn't read, they're not keeping up with IFAB and all the rule changes. Actually, we're doing it differently now. And there was an arbitrary change in the season. And now it's a new soccer. They're on a fiscal year. So like the fiscal year, right? The first game after July 1 is the game where all of the new rules get into effect. And it's very confusing to be the examiner on the field being like, actually, you didn't know about this. And I know you guys innovated and we responded, and now we've got a new, a new framework that we're using.
Yeah, well, but this also becomes the problem, and realizing we need to bring this to a close is, how do you push that decision making to the edge? Do it in a way that you're keeping up and not ticking off the constituents, to your point about rulemaking. But third, also, and we're seeing a lot of this right now. And this will, I think, maybe the next hot wings and hot takes, Kiah, for you and I. And this might be a Dara Tarkowski kind of call, but you're seeing a lot of application of regulation right now where banks are getting different answers depending on which regulator they talk to, even if it's within which examiner, even within the same regulatory body. We're finding there's this inconsistency in the application of regulation and guidance.
Oh, I completely agree with that. And, that's also it's not banks' fault, and it's hard because it's their problem. I don't know if examiners feel anguish when they're like, another agency or another examiner has given that information. And I think, that's just, I don't know if we're ever going to get that solved, but we do have some interagency guidance coming out around third-party vendors and around crypto. I don't know if banks really love the direction that all the regulators went, but there is certainly some this coming there. So, and then Jason, I'm really excited about your hot sauce empire that you're building, this logistics firm that you're running from your living room with your palette of hot sauces.
Well, it was a little bit hilarious over the holidays. I would say close to 50% of the gifts I received were hot sauce related.
No. Yeah, you're the hot sauce guy now.
But yeah, 17 packages going out today, lining up some fantastic guests. And I've got the full range, as people can see behind me. We have OCC Chipotle. We have the KYC Oh No Garlic Habanero. And then my personal favorite, my bank partner ghosted me Ghost Pepper.
Oh, that's incredible. That is incredible. Yes. You're crying, but we don't know why.
Oh, yes. Well, and I will ship my bank partner ghosted me to any fintech CEO who needs it, because it will just add to their tears.
Well, I would love to send this into added extra time, but I'm afraid I must blow the final whistle. The one thing I learned is that I don't want to be a referee or a regulator, as frustrating as it is.
If I can do it, anyone can do it.
Yeah.
I want that to be today's takeaway.
Well, Kiah, as always, thanks for joining us. You can read her article, Competitive Concerns Complicate M&A, in the latest edition of Bank Director. And we'll see both of you at Bank Director's Acquire or Be Acquired conference at the end of the month at the JW Marriott Phoenix Ridge Resort in Phoenix. I know a lot of our listeners will be there, and Jason, you'll be there as well. So we'll leave it there, and we'll see you again next week. Thanks, everybody.
Thank you.
That's it for another week of the world's #1 fintech podcast and radio show, Breaking Banks. This episode was produced by our US-based production team, including producer Lisbeth Severance, audio engineer Kevin Hersham, with social media support from Carlo Navarra and Sylvie Johnson. If you like this episode, don't forget to tweet it out or post it on your favorite social media, or leave us a 5-star review on iTunes, Google Podcasts, Facebook, or wherever it is that you listen to our show. Those actions help other people find our podcast, and in return, that helps us build an audience that can be supported by sponsorship so we can continue to provide you with our award-winning content every week. Thanks again for joining us. We'll see you on Breaking Banks next week.